For the past 10 years, crypto investors had a cheat code. It was called the 4-year cycle. It was tied to something called the Bitcoin halving. The plan was simple: buy before the halving, wait for the prices to rise, then sell about a year later. It worked so well that people started treating it like a rule. But what if that rule doesn't work anymore? What if that cheat code expired? The crypto market has changed, and investors who are still using the old playbook are getting hurt. Think back to late 2025. Everyone expected a huge rally. People were talking about a super cycle. They were waiting for Bitcoin to explode in price. Instead, the market dropped. At the end of 2025, Bitcoin actually closed the year down about 6%. That had never happened before in a year after the halving. So what happened? Is the 4-year cycle finally dead? In this video, we'll explain why the old pattern is breaking, and we'll show you the new forces that are now driving crypto. Things like ETFs, stablecoins, and the global economy. Bitcoin has something built into its code called the halving. About every 4 years, the reward miners get for creating new Bitcoin is cut in half. This lowers the amount of new Bitcoin entering the market. Here's what happened. In 2012, reward dropped from 50 to 25 Bitcoin. 2016, from 25 to 12.5. 2020, from 12.5 down to 6.25. And 2024, from 6.25 down to 3.1. Each time, less Bitcoin was created. When supply goes down, the demand stays strong. Prices usually go up. And that's exactly what happened. Bitcoin peaked in November of 2013, December of 2017, and November of 2021. This pattern seemed perfect. Buy before the halving. Sell about 12 to 18 months later. Easy. But now, that pattern is breaking. The first warning sign showed up in 2024. Bitcoin hit an all-time high before halving. That had never happened before. In past cycles, new highs came after the halving. Then came 2025. According to the old rules, that year should have been huge. Instead, momentum slowed down. The last part of the year, usually the strongest, was weak. And for the first time ever, a year after the halving ended in red. That shocked a lot of investors. But it's not enough to say the cycle is dead. We have to ask why. The answer is simple. The market has changed. Bitcoin is no longer just driven by small retail investors. Big institutions and global economic forces are now in control. If the halving is not the main driver anymore, what is? 3 big forces have taken over. 1. The ETF effect. In January 2024, spot Bitcoin ETFs launched in the US. An ETF is a product that lets investors buy Bitcoin inside normal brokerage accounts. This made it easy for big investors, like pension funds and investment firms, to buy Bitcoin. The demand was huge. Some ETFs bought Bitcoin more than miners were producing. BlackRock's ETF alone grew to over $60 billion in assets in less than just 2 years. This brought steady, powerful money into crypto, not just hype from regular traders. Number 2, the rise of stablecoins. Stablecoins are digital dollars. They are tied to the US dollar and used inside crypto markets. The stablecoin market is now worth over $280 billion. These coins are used for fast global payments, business transactions, and moving money between exchanges. They make crypto more stable and useful. This real-world use, not just speculation. Governments are now making rules around stablecoins, which makes them even more accepted. And number 3, Bitcoin as a global asset. Bitcoin is no longer in its own bubble. Its price now moves with the global economy. When central banks print money and add liquidity, Bitcoin tends to rise. When interest rates go up and money gets tight, Bitcoin often drops, just like tech stocks. That means things like Federal Reserve decisions, inflation data, and the global money supply are now just as important as the halving. Bitcoin has grown up. It now plays in the same league as other major assets. If you want to understand this new crypto world and stay ahead of these big changes, make sure to subscribe and turn on notifications. The old rules won't protect you anymore. You need a new strategy. If the 4-year cycle is no longer reliable, what should you watch instead? Number 1, watch ETF flows. Pay attention to how money is going in and out of Bitcoin ETFs. When billions are flowing in, that shows strong demand from institutions. 2, watch global liquidity. Keep an eye on global money supply and central bank policy. When liquidity expands, assets like Bitcoin usually benefit. Interest rate cuts now matter more than the halving dates. And 3rd, watch real adaptation. Look at stablecoin growth and real-world use. Also watch tokenization, where things like real estate and bonds move into blockchain systems. The more crypto connects to the real economy, the less it depends on a simple 4-year pattern. Some analysts now predict Bitcoin could reach $150,000 to $200,000, but based on these new drivers, not the old halving cycle. Let's be clear, the simple 4-year cycle tied to the halving is no longer the main force in crypto. The market has changed. Now the biggest drivers are institutional money through ETFs, massive stablecoin liquidity, and global economic forces. The easy strategy of following a calendar might be over. But a smarter strategy based on the real capital flows and global trends is just beginning. The investors who adapt will win. The ones stuck watching the old halving clock may get left behind. What do you think is the biggest force moving the market now? Let me know in the comments below. Remember, stay thoughtful and stay stubborn.